everyone, welcome to Current Affairs for Beginners, a unique initiative by Law Excellence. Let's start our today's session. These are the topics that we are going to cover in our today's video. Our first article is RBI cuts benchmark interest rate again, lowers GDP forecast to 7.2%. This article comes under GS paper 3 under the topic of economy. Here, the Reserve Bank of India has again reduced the repo rate by 25 basis points. So from the prelims point of view, we should know all about this Reserve Bank of India and we should know what is this GDP and what is meant by repo rate. First, let us see what is meant by this GDP, gross domestic product. It is the total value of final goods and services that were produced within the country in a particular year. So it is the total value of all the goods and services that were produced within India in a particular year. Now let's see about this Reserve Bank of India. RBI was established on April 1st in 1935 through an act known as Reserve Bank of India Act of 1934. And the central office of Reserve Bank of India was initially established in Calcutta. Later it was permanently shifted to Mumbai. And originally the Reserve Bank of India was privately owned. But in 1949 the Reserve Bank of India was nationalized. That means the RBI is fully owned by the government of India. That is what meant by nationalization of a bank. Then what are the functions of this Reserve Bank of India? It is general superintendence and direction of bank affairs. Superintendence means supervising or managing the bank affairs. And who is the governing body in this Reserve Bank of India? It is the Central Board of Directors who were appointed by the Government of India under this Reserve Bank of India Act of 1934 were the governing body of RBI. And this governing body consists of official directors who were full-time members, that is the governor and 4 deputy governors. And it also consists of non-official directors, out of which there are nominated members and also other members. The nominated were 10 members were nominated along with 2 other government officials, and the other members were 4 members, one from each local board. There are 4 local boards. One is in Mumbai, the other one is in Calcutta, the other one is Chennai, and the other local board is Delhi, New Delhi. As we said that the function of RBI is financial supervision. This financial supervision of RBI will be done under the guidance of Board for Financial Supervision. Now let's look into the main functions of RBI. It functions as a monetary authority because it is RBI who will formulate, implement and monitor the monetary policy. What is meant by monetary policy? It is maintaining price stability by keeping in mind the objective of growth, because stable prices are the prerequisites for sustainable development or sustainable growth. The next thing is it acts as a regulator and supervisor. It will prescribe what are the parameters based on which the banking and the financial system in the country should function. These parameters are necessary because our financial system should maintain public confidence. Public should have the confidence in our financial and banking system, and the depositors' interests should be protected, and also there should be a cost-effective banking services to the public. These are the objectives of RBI. And it also functions as a forex manager, that is a manager of foreign exchange. It manages the Foreign Exchange Management Act of 1999 in order to facilitate external trade and payment and to promote the foreign exchange market in the country. And the next thing is, it is the issuer of currency. It will issue and exchange, or it will destroy. It will only issue and it will destroy the currency and the coins which are not fit for circulation. That means if the currency or the coins are not in a good quality, it will destroy them, and it will also issue the adequate amount of currency notes and coins in the good quality to the public. The next is, it plays developmental role. It performs a wide range of promotional functions to support the national objectives. And other related functions are, it acts as a banker to the government in order to perform merchant banking function for the central and state governments, and it also acts as their banker. And it is a banker to banks. It will maintain the banking accounts of all the scheduled banks. Now let's look into some of the previous year questions with regard to this Reserve Bank of India. Consider the following statements regarding RBI. It is a banker to the central government. Just now we have seen it formulates and administers the monetary policy, and it acts as an agent of government in respect of India, and it handles the borrowing program of Government of India. All the statements here are correct. So the answer here is C, 1, 2, 3 and 4. And this question has appeared in 2001 UPSC Prelims. The next question is, consider the following statements. RBI was nationalized on 26th January of 1950. We have seen that it was nationalized in 1949, not 1950. And the borrowing program of Government of India is handled by the Department of Expenditure, Ministry of Finance. This is incorrect because the borrowing program of Government of India is handled by the Reserve Bank of India. As both the statements here are incorrect, the answer here is D, neither one nor two. Students, the reason for us to show these prelims questions, previous year questions, is to tell you how important is our core video, because here we won't focus on the stories that appear in the news. Here our intention is not to explain you the story or analyze, but our intention is to help you how to crack prelims. Here we will focus only on the prelims topics. If you look into these questions, we have covered all these topics in the discussion just we had now about the Reserve Bank of India. This is how we will be working for prelims in our core video. The next article is linking small loans to external benchmark after further talks. This article comes under GS paper 3 under the topic of economy. Yesterday we have seen that the Supreme Court has quashed the RBI's 2018 circular to all the banks of India in resolving the bad loans. And RBI has also proposed the banks to use an external benchmark rate. Here I have told you while explaining about this marginal cost of lending rate in our yesterday's video. We spoke about a concept known as repo rate. Here the repo rate is the fixed interest rate. It is the interest rate at which banks can borrow money from the Reserve Bank of India by giving some collateral. Here repo, it means repurchase, so that the banks will use the government securities as a collateral, as a surety. And here repurchase means it will repurchase these securities after a maturity period from the Reserve Bank of India by paying back the money it had borrowed. And it borrows the money at an interest rate that is known as repo rate. Right now the repo rate is 6%. So if banks, the Reserve Bank of India reduces this repo rate, then banks will get in loans at a lower interest rate. That means they are getting benefited. So banks are supposed to transfer this to the customers. But the problem here is banks are not transmitting their benefits they were acquiring through the reduction in the repo rate. This is because banks were having an internal benchmark rate known as MCLR. MCLR is a rate below which they cannot lend to its customers. This is the minimum interest rate. So the Reserve Bank of India is asking the banks to set up an external benchmark rate, but even that is getting delayed. This entire article is talking about the monetary policy and the monetary policy instruments that were being used. Now let us look into all of them. Before going into the monetary policy instruments, first here we should know about a term known as net demand and time liabilities. What is meant by this liability? It is the responsibility, or it is something that we have to pay back. We have seen that assets, in case of a bank, loans are considered as assets because they will bring in some profits, whereas the deposits that were deposited by the customers in the bank were the liabilities on the bank's part, because bank has to repay these deposits along with the interest amount. And these deposits were of two types. There were demand deposits and there were time deposits. Here you can see demand deposits means here I have deposited my money in the bank and I'll demand whenever I want it back. I can use a voucher to get the money, to draw the money, or I can use my ATM card to get my money. So here the savings account and the current account that we maintain were known as demand liabilities. What about the time liabilities? These are the deposits which we get at the end of the maturity period. For example, I have done a fixed deposit of 2.5 lakh rupees for 5 years. So I can't take this money whenever I want. I can go get this money only after 5 years because this is a maturity period. So these are the time liabilities. And one more thing here is I have mentioned other demand and time liabilities. The net demand and time liabilities are nothing but demand plus time minus other demand and time liabilities. Here the banks will take deposits from the customers and they will use this money to invest in some business, or they might use this money and deposit in a big bank. So for that deposit they will get this interest, out of which some portion will be the bank's profit and the other amount, the principal amount, has to be paid back to the depositor along with some interest. So this profit which the bank is getting through the investments of the depositors' deposits will be subtracted from this. This will be known as the net demand and time liabilities. What is meant by this monetary policy? I have said that monetary policy means stabilizing the prices by keeping in mind the objective of growth without compromising the growth. So to do this, the Reserve Bank of India is the one which will formulate and implement this monetary policy using some instruments. We can say them as the tools which the Reserve Bank of India uses to keep the prices in a stable condition. Let us look into all this. First thing is repo rate. Just now we have discussed about it. It is the rate, fixed interest rate at which banks can borrow money from the Reserve Bank of India, and the present interest rate is 6%. Reverse repo rate means it is the interest rate at which RBI can borrow money from banks. Here we should know one thing. By increasing the repo rate, that means it is increasing the interest rate so that banks will borrow less money. Though they borrow, but they will have to lend to its customers at higher interest rates, which will discourage people from borrowing from the banks, so that there will be less money supply in the economy. So if repo rate is increased, then there will be less money in the economy. If repo rate is decreased, then there will be increase in the money in the economy. So we know what is meant by liquidity. Liquidity is nothing but money supply. So RBI will increase the repo rate to absorb the liquidity. it will decrease the repo rate to inject liquidity into the economy, and that is the same with reverse repo rate also. Here the RBI will absorb the liquidity by borrowing money from the banks using this reverse repo rate. This is the interest rate at which RBI will absorb the liquidity from the banks. The next thing is liquidity adjustment facility. Here the name itself indicates that liquidity adjustment mechanism for the banking system. That means when there is a shortage of money supply or liquidity, then this is aimed to inject the liquidity. When there is excess money in the economy, it will absorb the liquidity. For all these purposes, this liquidity adjustment facility is working in an automatic manner based on these two, repo rate and reverse repo operations. So the central point of this liquidity adjustment facility is liquidity injection will be done through repo operations, and liquidity absorptions from the bank to the RBI is done through this reverse repo rate option. The next thing is marginal standing facility. Marginal standing facility is the rate at which the scheduled commercial banks will borrow money from the RBI for overnight against the approved securities. But here they can borrow the money at 2% of their net demand and time liabilities, which we have already seen. So under the marginal standing facility, a scheduled commercial bank can only borrow 2% of its net demand and time liabilities from the Reserve Bank of India. Next, bank rate. This bank rate is 1% higher than the repo rate that is charged by the RBI when it gives loans to the commercial banks. Here it is different from this MSF because here this is a long-term loan and it is applicable for all the commercial banks, and there is no limitation like the banks have to borrow only 2% of their NDTL, and here this MSF is for a short-term loan. The next thing is cash reserve ratio, CRR. This is very important. CRR is the percentage of liquid reserves every bank must keep as a cash reserve with the Reserve Bank of India in their current accounts. The banks will not get any interest for these deposits. The present cash reserve ratio is 4%. The next thing is statutory liquidity ratio. This is the percentage of liquid reserves every bank should keep as a cash reserve with itself. CRR means it has to keep with the RBI, whereas SLR it should keep with itself in the form of gold or government securities. At present, the SLR ratio is 19.25%. And the next concept is open market operation, which we'll be seeing in the further articles. Next, we'll see about this market stabilization scheme. Market stabilization scheme. This will be used when there is high liquidity in the system. Under this scheme, the government bonds, the government securities will be issued by the Reserve Bank of India. These will be sold by the Reserve Bank of India in order to absorb the excess liquidity in the market. Now let's see some of the prelims questions with regarding this monetary policy instruments. An increase in the bank rate generally indicates that what is meant by bank rate? It is 1% higher than repo rate. If repo rate is increased, then there will be less money supply in the economy. So even if bank rate, it is 1% higher. So if it is increased, then it means the central bank is following a tight monetary policy. If it decreases, that means it is following an easy monetary policy. So the answer here is D. The next question is, banks are required to maintain a certain ratio between their cash in hand and total assets. Here banks are required to maintain a certain ratio between their cash in hand and total assets. That is SLR, statutory liquid ratio. Here we are not saying banks are required to maintain the reserves with RBI but with itself. If it is with RBI, then it is CRR. The next questions are, bank rate implies the rate of interest at which the Reserve Bank of India discounts the bills of exchange. It is nothing but the Reserve Bank of India is lending to the banks. The next statement is, with reference to Indian economy, consider the following: bank rate, open market operations, public debt, public revenue. Which of the above are the components of monetary policy? We have seen what are all the instruments of monetary policy. Public debt and public revenue doesn't come under that. So the answer here is C, only 1 and 2. When Reserve Bank of India announces an increase in CRR, what does it mean? CRR means it is the percentage of liquid reserves the bank should maintain with the Reserve Bank of India, so that it is reducing the money that the bank will have, so that the commercial banks will have less money to lend. If it decreases, they will have more money to lend. So the answer here is A. In the context of Indian economy, open market operations refers to. Okay, let me explain you what is this open market operation here. So this will be applicable in two conditions: when there is excess liquidity and when there is very low liquidity in the economy. What the Reserve Bank of India will do is, it will sell the government securities, government bonds in the open market if there is high money supply in the economy. So when there is too much of money supply in the economy, it is increasing the purchasing power. So when there is more money that is chasing very less number of goods or a stable number of goods, so that it will increase the demand and it will increase the price of that good. So when there is increase in the purchasing power, it will lead to inflation, which means general rise in the level of prices. So when there is high liquidity in the economy, the Reserve Bank of India will sell these. It will sell these government securities in the open market through an auction. So if they sell these bonds, it can suck out all the money from the economy. And if there is very low liquidity in the economy, it will buy the government securities. It will buy from the market, that is from the banks, so that it can inject liquidity into the economy. So now let us see this question. In the context of Indian economy, open market operations refers to purchase and sale of government securities by the Reserve Bank of India. The answer here is C. Now let's see the next article. No surprises. This article comes under GS paper 3 under the topic of economy. We have seen that the Reserve Bank of India has reduced the repo rate by 25 basis points, and now the present repo rate is 6%. Then who will decide this repo rate? It is this Monetary Policy Committee. From the prelims point of view, we should know about this Monetary Policy Committee. Now let's look into it. Monetary Policy Committee. This was established by amending the Reserve Bank of India Act of 1934 in 2016. This gave a legal basis for Reserve Bank of India to operate monetary policy framework. What does this monetary policy framework means? Setting this repo rate. And it has led to, this amendment has led to the establishment of 6-membered Monetary Policy Committee. And the main purpose of this Monetary Policy Committee is to set this repo rate, that is the policy interest rate, in order to achieve the inflation target. Before this Monetary Policy Committee, there used to be a Technical Advisory Committee that used to set this repo rate. And this Technical Advisory Committee is consisted of experts from monetary economics, central banking, financial markets, and who are having expertise on public finance. They used to advise the Reserve Bank on this monetary policy. But their advices were only advisory in nature, they are not binding. And with the formation of this monetary policy committee, this technical advisory committee has stopped functioning. Now, let us see what is the composition of this monetary policy committee, which is important. Here we have said that it is a 6-membered committee consisting of Governor of Reserve Bank of India, who will be the chairperson. That means he is heading this committee. And it will have the Deputy Governor of Reserve Bank of India. He is the in charge of this monetary policy. And one officer of Reserve Bank of India, and he will be nominated by the Central Board. We have seen that the Central Board is the governing body of RBI, and the other 3 members will be appointed by the government, and the tenure of these 3 members is they will hold the office for 4 years. Now let's look into the policy making, monetary policy making. This committee has to meet, it should meet 4 times in a year, and the minimum number of people should be there to conduct a meeting is 4 members. Then how they will take the decision? Through voting. Each member, all the 6 members were having 1 vote each. In case of a tie, when there is equality of votes, then the governor, who is the chairperson, will have a second or casting vote. And this monetary policy committee should file or submit a report, monetary policy report, once in every 6 months. Now let's look into a previous year prelims question. Which of the following statements is or correct regarding the monetary policy committee? It decides the RBI's benchmark interest rate. Yes, the policy interest rate, that is the repo rate. It is a 12-member body including the governor of RBI, and it is reconstituted every year. This statement is incorrect. We can reject it at the first itself. It is a 6-member body and it is not reconstituted every year. Here the members who were appointed by the government itself, they were having the tenure of 4 years. And it functions under the chairmanship of Union Finance Minister. It is wrong. The chairman is the governor of RBI. As 2 and 3 are incorrect, the answer here is A, 1 only. The next article is Stressed Assets Circular to be revised soon. This article comes under GS paper 3 under the topic of economy. We have been seeing that the Supreme Court has quashed the RBI's circular to all the banks in order to resolve this bad loan issue. So now from this article, what is important from the prelims point of view is section 35AA of Banking and Regulation Act. What is this section 35AA? This section 35AA will authorize the Reserve Bank of India to issue directions. It can issue directions on initiating insolvency resolution in case of a default. We know what is meant by insolvency: inability to repay the debt. For example, let us take a company. This company has taken loan from a bank, let it be SBI, and this company, due to some internal and external factors, due to the failure of its business functioning, it failed to repay its loan. Now this situation will be known as insolvency, and if it is legally declared, then that is known as bankruptcy. So how to resolve this issue? It is a very huge loan. The bank's financial health will get affected, because banks will have its liabilities. It has to repay to its depositors. So banks shouldn't run into losses. For this reason, we have brought in a code known as Insolvency and Bankruptcy Code, which deals with insolvency resolution process. So RBI, according to this section 35AA, when it finds a case of insolvency, it can issue directions to initiate the proceedings under this insolvency and bankruptcy court. The next article is in Supreme Court, Government Defends Electoral Bonds. This article comes under GS paper 2 under the topic of polity. From the prelims point of view, here we should know about this electoral bonds. Electoral bond scheme. What is an electoral bond? This is a banking instrument that will be used for funding the eligible political parties. Here you have to remember, I am saying not all the political parties but eligible political party. How we will say that a political party is eligible in receiving this electoral bond? Here the party should be registered under the Representation of People's Act of 1951 and it should have secured more than 1% of the votes that were polled in the last general election to the Lok Sabha or the Legislative Assembly. So here, what is the validity of this electoral bonds? This bond will be valid for 15 dates from the date of issuing the bond. And how can we encash this electoral bond? So can the political party encash it in any account? No. These electoral bonds can be renamed only by an eligible political party by depositing this bond in a designated bank account that is maintained with an authorized bank. And who can purchase these electoral bonds? Who are selling this? It is banks, and that too, to be specific, SBI is the sole authorized bank to sell these electoral bonds to the persons, especially the citizens who wants to fund the political parties. So here electoral bonds can be purchased by citizen of India or an entity that is incorporated or established in India. Person means an individual, a Hindu undivided family, a company, a firm, an association of persons or a body of individuals can purchase these electoral bonds. That means here no foreign currency, only Indian rupees are accepted for purchasing these electoral bonds, and these electoral bonds will be available in the denominations of 1000, 10,000, 1 lakh, 10 lakh and 1 crore. So the minimum amount that can be funded is 1000 and the maximum amount is 1 crore. The most important thing here is the identity of the donor will not be disclosed. Only the bank who is selling this bond to the donor will know who is the donor, but the political party will not know who is the donor. The next article is jobs or doles, which is the way forward. This article comes under GS paper 2 under the topic of governance. From this article, now we are going to see about a few schemes and also what is meant by minimum income guarantee. Dear students, we have already seen all these things, but some of the students were saying that to revise it once again. So let me revise it. First of all, what is meant by this minimum income guarantee? It is a system of providing social welfare provisions that will guarantee all the citizens or families with an income that is sufficient for them to live. That is providing an income for all the citizens or families for their survival, and that too this income will be provided based on certain conditions like citizenship, economical backwardness. All these will be taken into consideration to provide a minimum income guarantee. Then what is this Nyuntam Yojana? The Congress party in its manifesto, it has promised that it will launch this minimum income guarantee scheme. This Nyuntam Yojana is a minimum income guarantee scheme which will transfer 6,000 rupees per month into the bank accounts of 15 million families who comprises the poorest of the poor, that is people belonging to AAY and below poverty line, Antodaya Anna Yojana. And this will cost around 3.6 lakh crore to the exchequer. Now let's see what is this PM-Kisan, Pradhan Mantri Kisan Samman Nidhi Yojana. Under this program, the government will provide all the vulnerable land holding farmers. It is not landless, land holding farmers with a cultivable land up to 2 hectares. Please remember here it is not 2 acres, it is 2 hectares. The vulnerable land holding farmers who are having a land up to cultivable land up to 2 hectares, they will be provided with 6,000 rupees per year under this PM-Kisan Yojana. And this 6,000 rupees will be provided in 3 installments, 2,000 rupees each in each installment. The next thing is MGNREGA that is mentioned in this article. It is Mahatma Gandhi National Rural Employment Guarantee Scheme that was enacted in 2005. And this scheme is to provide 100 days of employment in every financial year to the adult members of any rural household. Whoever is interested in doing a public work, and that work is related to unskilled manual work at a stipulated minimum wage. So this is about providing employment to the rural households for doing unskilled manual work for 100 days by providing a minimum wage. And this scheme will be implemented by the Ministry of Rural Development. The next article is banks have cut MCLR by 10 basis points, but more needs to be done. This article comes under GS paper 3 under the topic of economy. Here, the Reserve Bank of India has been asking for monetary transmission. What is monetary transmission? The RBI has reduced the repo rate so that banks are getting loans at lower interest rate. So these benefits should be passed on to the customers. So this transmission is known as monetary transmission. But they are failing to do so because there is an internal benchmark rate known as MCLR. Now the banks even have reduced this MCLR by 10 basis points as the Reserve Bank of India has reduced the repo rate by 25 basis points and now the repo rate is 6%. What is this MCLR? It is the minimum interest rate. Minimum interest rate that was set by the banks. Below this minimum interest rate, banks cannot give loans to its customers except in some exceptional cases, and that too if they are prescribed by the Reserve Bank of India. Now let's look into a previous year question. What is or the purposes of marginal cost of funds based lending rate, announced by RBI. This is a 2016 question. These guidelines will help improve transparency in the methodology followed by banks for determining the interest rates, and they will help ensure availability of bank credit and interest rate that are fair to the borrowers as well as to the banks. Yes, both are correct. So the answer here is C, both 1 and 2. And this is all for today, and see you all on Monday. As tomorrow is Ugadi, a Telugu New Year, so there will be no core video for tomorrow, and day after tomorrow will be Sunday. See you all on Monday. Thank you.